About today is, five or six things. Number one, is our experience of investing in India over the last 6 years in terms of lessons learned. A little bit about, you know, between local and international capital. I've had the privilege of sort of managing, raising, investing, exiting from both types of capital. A little bit about, project level or SPV level investing as opposed to, entity level investing. And then, a little bit around debt, because that seems to be the flavor of the month or the quarter, maybe the flavor of the year, given that banks in general and public sector banks in particular are shying away from, lending to the sector. To some extent, I guess, the RBI is right in sort of, recommending that we stay away from an asset bubble. And the other thing I'd kind of, talk about is opportunities, challenges, a little bit about exits. So, on that note, in one sentence, as far as my experience and our experience of investing, it's been very good. I think, when we started investing, everybody would say, three things are important: location, location, location. But I think very quickly people realized that equally important, if not more important, was execution, execution, execution. And I think if we look back, hand to heart, if I underestimated something when I first started investing in real estate in India, I think it was the extent of asset management, and hand-holding that we would need to do with our development partners. And so fairly early on, at least in terms of our experience, we built out, a team of people, with 2, 3, 4 decades of experience at places like Larsen & Toubro, DLF, Unitech, and the like. People who'd got their hands dirty and their feet wet. Because I think the strategy of spray and pray, has a very high risk, and I think it's a better strategy to sort of buy and build, rather than spray and pray. And I think it's also equally important to be able to add, true, significant, and sustainable value to the capital that you're providing. Because at the end of the day, money is a commodity. The other thing I think that's, at least in our experience, we've found is a mix between entity level and project level. From 2 or 3 points of view. Some assets are perhaps better done from an entity level. As an example, hospitality. Just because the gestation period on a single property hotel, is going to be longer, it's probably better from an investor's point of view, as well as from an exit point of view, to consider a portfolio of hotels. That from an exit point of view, you could perhaps IPO, and equally, there could be instances where, for reasons of control, you may not want to do an entity level investment, or where, you think that you don't have confidence in the team, to be able to deliver and do all the things or not, because once you put money into an entity, you have no control over where it's going to go. So if there are systems, processes, people that you trust, that's where you would do it. Or you would do, for example, what we did with a couple of our partners, which is to put money into one asset, and then do multiple assets or do entity level investing, once you've got comfortable. The third thing that I thought I'd kind of talk about is our experience with asset and portfolio management in terms of insourcing versus outsourcing development. Many of my peers have kind of taken a position that they'd like to insource development from a control and ability to deliver point of view. And that is a completely different business. Then you pretty much become, a developer. And I think the experience, at least as far as foreign funds are concerned, is relatively short and the jury is still out. But for the most part, I would say, private equity investing is one business, development is another. And perhaps you'll hear one of my colleagues tell you that hospitality is a third. It's a completely different asset class, within real estate. As far as, domestic versus foreign money is concerned, I think I'll just touch upon two quick points. Number one, the fact that as far as raising money is concerned, we have very few, if any, really large, sizable institutional investors in this country, particularly for real estate. The same, though, is not true for private equity, which I've had the privilege, of running as well. But if I were, for example, to think, can anybody write, a 100 crore check or even 150 crore check as one check for a real estate investment? That doesn't happen. But I have a $100 million investor in my fund. There are some limitations on what domestic money can do and what foreign money can't do. But I think for the most part, our experience has been that, the only limitation you have with foreign money is the fact of size, which also you can, is not such a big deal, particularly if you're doing development. 50,000 square meters is not a big deal. The second issue, which is more fundamental, is one of timing. You put money into a residential asset, it starts generating money before 3 years, you can't take it out. It's unfair, to my development partner, the fact that, he needs to have me there. So I think, for another forum, perhaps on real estate, we could talk about how we've overcome that, but there are ways around that problem as well. Lastly, on debt and a little bit around sort of, tier 1, tier 2 versus kind of, tier 1 versus tier 2. First that. Our focus has been pretty much on the top 7, 8, 10 cities in the country. And the reason is twofold. Number one, if I'm going to do 50,000 square meters minimum, I don't want to be, 40%, 50%, 70% of the annual sales in that city. So if I'm going to end up in, Rajkot, for example, with a project that's 1 million square feet, particularly if it's not residential, I don't want to be, doing 80% of the annual sales in that city. The second thing is that as India urbanizes, I think there are going to be lots more opportunities, particularly for the asset classes that we've focused on, which has been predominantly residential. And that brings me to my last point, or second last point, which is around exit. Our focus has been on residential for two reasons. Number one, residential is the largest asset class within the real estate sector in our view. The second is that, from a risk reward and a cash flow point of view, we think, residential is better. And thirdly, it's a self-liquidating asset class. So I really need to worry far less about how I'm going to exit, a single property hotel, a retail mall, or 2 million square feet of office space in Hyderabad or Bangalore or Chennai. The last thing is really around kind of opportunities. I think size matters, location matters, but like I said when I started, execution matters much more. Somebody asked me what is, how do you select development partners? And I said, listen, I could give you a lot of MBA bullshit, but the honest answer is, somebody who's going to pay me my money back. The second question that I often get asked is around strategy. And I think we were talking about it last night. Execution is the strategy, particularly in real estate. The other thing I think that's important when you kind of, look into the future is that, and Jay will talk perhaps a little bit about this more, is we've been a big believer in the base of the pyramid. And where we started was really value for money housing. 90% of my residential portfolio is units which sell at, in the ballpark of about 2,700 to 3,300 rupees a square foot. As an example, we sold 7,000 units in that price point in the last 12 months in Noida alone. Just Noida alone. And we've collected 30%. Phase one of that is up 14 towers in a matter of 12 months. So if you kind of build customer confidence, you treat your employees well, you work with your stakeholders, whether contractors or other people, I think, and you treat your development partners from a solution orientation point of view. As an example, all of our sites have, a guy who's spent anywhere between 20 to 40 years in execution. just to help our development partners, scale up. Because candidly, real estate development in India is no more than 6 or 8 years old. Sometimes in many cities, not even that much. So I think the opportunity is huge. The opportunity is there. There will be ups and downs. There are opportunities in both tier 1 and tier 2 cities. There are opportunities across asset classes, maybe less, maybe more. Everybody follows a different approach. But I think, the only, if I were to kind of, crystal ball gaze, the only thing that I think concerns me is the ability to get leverage, not so much for our assets as sometimes for our customers. And I'm not talking only of home buyers. For example, you need to build a commercial office space. The ability to get long-term debt is challenging. And for example, in December of 2008, I presented to the boards of 3 public sector banks for one of our development partners, saying, crisis or no crisis, here is a good project. You underwrite it to whatever you want to, but you can give me at least 100 crores of construction finance. And I was very pleased that our development partner was, in the subsequent 15-month period for its various other projects, many of which we were not involved with, was on his own able to raise 600 crores of debt. Today he's a public company, well respected. But when I look into the future, I'm concerned that the amount of management time and effort that will go into looking at government issues and that will go into raising debt, I think that's taking away from what our partners and we need to do. Thank you.
Thank you.